Hi everyone, I'm the Tax Pro, and today I'm going to show you how to handle loans within QuickBooks Online. So we're going to go in, we're going to create some loans. I'm going to show you how to create loans when you're purchasing an actual physical asset, and then I'm going to show you how to create loans if you're just getting like a cash loan. I'm then going to show you how to handle the payments on those loans. Okay, so this is the new QuickBooks Online dashboard. This is the new layout for 2025. The easiest way to do this is through journal entries. Okay, so to get to the journal entry space, we're going to click on this plus create button. We're going to go under other and click journal entry. Journal entries look a little bit different. Okay, this is starts showing us what the true accounting background inside QuickBooks Online looks like. We have accounts, debits, credits. This can be a little bit confusing, okay? It's really important that as I go through and I show you how this works, that you pay attention to what accounts you're debiting and what accounts you're crediting. Because if you get them backwards, then you're not gonna have the desired result, okay? When it comes to filling out this journal entry, you're gonna have your journal date, your journal number. So journal numbers can be based on a specific process or procedure that you have inside of your business. Perhaps you need to have them numerically ordered, or you have to put initials of the individual who is creating that journal number, something along those lines. You can also, use a description if you don't have specific processes and procedures. I'm just going to go ahead and leave it at journal number 1. There is an area that you can put memo on here with this journal, so you can go ahead and, explain what's happening within the memo itself. So I could say, loan for the purchase of a sales car. So maybe we're purchasing a sales car. You can have attachments on here as well, so you could put the purchase documentation on here. So let's start with account. I'm going to show you what happens if we're purchasing an asset first, and then I'll show you what happens if we're purchasing an actual, just like doing a cash loan, okay? Now, you can go in and you can create the accounts that you're going to want to use inside of the chart of account feature, or we can create them as we go. I'm going to show you how to create them as we go, because to me that makes the most sense, it's easiest, and it's just going to kind of keep our workflow moving. But you can go in and you can kind of get yourself organized within the chart of accounts first if you would like. So we're going to purchase a sales car. So I am going to create an asset for sales car. And assets are things that you're going to be using over the course of multiple years. This is going to be considered a fixed asset. So I'm going to type in the account name, and then I'm going to select account type, fixed asset. And then there's detail types. So there's a bunch of different details that QuickBooks Online gives us the option to select from. There's a vehicle section. The original cost, so let's say that I'm paying $25,000 for this sales car. You don't have to fill out the original cost section, by the way. This is optional. And then we can click this checkbox, and this will create 2 separate accounts if we click this checkbox. So this is going to create an account for the actual original cost of the sales car, and then it will create an account for the depreciation. I'm going to go ahead and let QuickBooks do that for me, but you do not have to, okay? You can always create the depreciation account at a later date when you actually record depreciation on the asset. I'm not going to go too far into that because that's kind of a different topic. I'm just going to kind of show you what steps you want to take as you manage this fixed asset. So there's no depreciation so far on this vehicle, so I'm going to leave this blank, save, and when it comes to assets, if you are increasing your asset, you are going to debit your asset. So I am going to debit the sales car, okay? So this is maybe going to be, a Ford Fusion for sales team. And then maybe I want to put, it's a 2024 or something along those lines. So I've debited my asset. Now I went in and I paid $7,500 cash down payment on the sales car. I'm going to take that out of the checking account where I wrote that check out of. $7,500. Okay, so this is a down payment on the car, and it's nice to kind of fill in your description. So the description for each line item ties to that specific line item, whereas the memo itself covers the whole entire journal entry. So it's kind of nice to narrate, especially as you're getting used to journal entries, in the description each line item as you go. If you have cash coming out of an account, so out of a checking account, that is a credit. You reduce your checking, your savings, that kind of thing with a credit. So we want to credit that. Now we need to cover the rest in a loan. So let's say that we went to, a Sunshine Bank, and this is a Sunshine Bank loan. So we're going to put, Sunshine Bank loan. I'm going to create a long-term liability. So you're going to see that there's also other current liabilities. Current means that we're going to pay this off within a year. This car loan is probably not going to be a year car loan, right? So it's going to be long-term. It's longer than a year. When it comes to the detail type, you have notes payable, which is essentially like a loan. Other long-term liabilities are shareholders. So shareholder would be a loan that you have essentially from a shareholder. I'm just going to leave it at notes payable. You don't have to put the unpaid balance in here, okay? This is going to create an entry against an account that we don't really want to have in there. We want to enter the information as we go because it allows us to tie it to like the sales car, okay? So then this is going to be the amount, So this is the amount financed. Now we've paid $25,000. We are not going to include any interest that we're going to be paying over the life of the loan. Does not go into the loan account, okay? It does not go into the loan account. So let me kind of go through what we've done here. We have a sales car. We have paid $25,000. We'd agreed to pay $25,000 for this Ford Fusion. Okay, and you can put the name of the vendor in here if you wanted to, like maybe, Gary's Car Lot or something like that. So let's, create Gary's Car Lot. He's technically a vendor. And then you could do Sunshine Bank here. They're technically going to be a vendor. Okay. So we have gone ahead and we've agreed to purchase this Ford Fusion from Gary's Car Lot for $25,000. We've paid $7,500 down on that car. It is coming out of our checking account when that check clears. And then we are going to, and this can also go to Gary's Car Lot. And then we have financed $17,500 with Sunshine Bank, okay? When we save and close this, couple of things are going to happen. This is going to go sit on your balance sheet, okay? So if we pull up the balance sheet, inside of our balance sheet today, we are going to see our sales car. The original cost was $25,000, okay? Our checking account here, our primary checking, this will go down by that $7,500 down payment. And then we are going to have Sunshine Bank loan for $17,500, okay? So we have recorded this particular asset and we've recorded that liability. Now let me show you what happens if we just are getting cash, okay? So we're going to come here to the plus create button and let's say that we're taking out a cash loan. We are going to just leave the journal number there. And let's say that they're going to deposit this amount into our checking account. So primary checking, to increase your checking account, you debit. Okay, so we're going to, take out $50,000 loan from, we'll just do Sunshine Bank again, okay? So Sunshine Bank, we're going to get a loan of $50,000. Now we want to create a different loan account, right? Even though it's from Sunshine Bank. We are going to create Sunshine Bank working capital loan or something along those lines. Again, this is going to be a long-term liability and a notes payable. So this is a little bit more simple. We don't have an asset going on there. Literally the asset is coming into our checking account as cash. Okay, so a couple of things here are going to happen. We save and close this. This is our balance sheet, okay? Our primary checking has gone up by $50,000 because we said, hey, we have $50,000. It's getting deposited into the checking account. And then we have this Sunshine Bank working capital loan for $50,000. Okay, so we've now increased our loan amount and we have increased our checking account. Now, what about payments? How do payments work? I get a lot of people who are confused about the way that we record payments against loans. So a couple of mistakes that I see. One, people immediately expensing those payments. So they're saying, okay, well, this is a loan. The money's coming out of my bank account, therefore it must be an expense. And then it's hitting their checking account. Or sometimes I'll see people who just take it all the way against the loan and they don't account for interest. So when you pay on your loan, you generally have principal, which is the amount that goes against the actual loan amount. Okay, so if I'm going to pay on this working capital loan, let's say that I'm paying $1,300, and I'm just throwing numbers out there. Let's say $1,000 is going to reduce this $50,000 amount. Okay, so I'm going to pay, and then I have $1,000 that's going towards the principal. That $300 may be composed of a couple different things. You might have like a bank fee in there. You may have interest. And so we split those amounts out, and those are expenses. So we don't get to write off the actual capital, the principal of this loan. The reason being is because we didn't recognize the cash coming in as income, right? So because we didn't recognize it as income, we don't get to write off the payments towards the principal. However, we do get to write off the payments for bank fees. We do get to write off the payments for interest. Okay, so ways that you can do this. Again, I kind of like to do this in a journal entry. I think that people can see it a little bit better than if we just use the bank feed. I like to do a journal entry and then match the bank feed entry to the journal entry. Some people may prefer to break out the principal and the interest within the actual bank feed itself. I find that people make more mistakes that way. So we're going to go to the plus create. Let's do a journal entry. So let's say, we're maybe 2 days down the road. Obviously, you wouldn't have a loan payment this quickly, but let's pretend like you do, okay? So we have a couple things happening here, okay? We have $1,000 is going towards that loan, that working capital loan. We are going to debit this loan in order to decrease it. When it comes to loans and liabilities, you credit to increase and you debit to decrease, okay? Different accounts you debit and credit to increase or decrease, but they're not all the same. Loans, you credit to increase, you debit to decrease. So we're saying we've paid $1,000. This is the principal portion of the payment, okay? This is not an expense. This is just reducing that loan amount. But I maybe have bank fees and I don't have an expense account set up. So I'm going to go ahead and do that really quick. So we're going to have an expense and we're going to have bank charges. Okay. So I've set up bank fees. I have bank fees of maybe $75. Okay. So this is going to be bank fee for, loan statement or something along those lines. Obviously it's not going to be $75, but we're just going to say it is. And then I have $225 in interest. So I am going to create an interest expense account. Expenses, interest paid. This is going to be for $225. So I have interest paid. And then all of this is going to be coming out of my checking account as a $1,300 payment. Okay. I can put Sunshine Bank in here, Sunshine Bank in all of these. Now, how do you know what the interest is? How do you know what the checking or what the bank fees are? How do you know that? Where does that come from? That's going to come from your bank statements, okay? That's going to come from your bank statements. So right here, we have gone ahead, we've taken $1,000 towards the principal, we've taken $75 from the bank fees, we've taken $225 to interest, and that's a $1,300 loan payment coming out of our checking account. Now, if we record this and then later we go to the bank feed and there's a $1,300 payment to Sunshine Bank coming out, it should match this. You should be able to match it that way because the $1,300 is still coming out of the bank. We've just split this up. The bank fees and the interest expense, these are going to be items that we write off on our tax return. So then people may say, well, what about the $1,000? Well, if this was a loan for an asset, we would be recovering the cost of that asset via depreciation. The working capital, I'm assuming, is going to pay expenses. So in a way, you do have write-offs being generated from that loan. It just looks a little bit different. Okay, the loan itself we don't write off because we don't claim the loan coming in as income. So we're going to save and close this. Now, I'm going to do one more step that's really important with loans. I'm going to show you how to reconcile to your bank statement. So essentially what's happened is I made this loan. I'm looking at my loan statement that came in. It is saying, okay, you've paid $1,300. You have $1,000 that went to principal, $75 that went to bank charges, $225 that went to interest. And your remaining balance is going to be $49,000. What I'm going to do is I'm going to come in here to reconcile. So you can go into accounting and reconcile, or my favorite is to go up to this gear icon and click on reconcile. And we are going to find the Sunshine Bank working capital loan. The ending balance is $49,000. Ending date. This would be the statement date. Okay, so you would get your ending balance based on the statement, and your ending date based on, again, your statement. So we would start reconciling, and there we go. It's $0. We're gonna finish now. Some items that would throw this off would be if you took the whole entire payment and you didn't break out interest, okay? So if you didn't break out interest or you didn't account for bank fees, then your ending balance would be wrong and you wouldn't get this $0 difference. We're gonna finish now. And what you're gonna notice is if we go back to the reconcile page for this working capital loan, it's gonna give us the last statement ending date, and it's gonna give us the beginning balance for our new statement. So let's say that, we pay another $1,000 towards the principal. You would end up putting $48,000, and then you would have your ending date be the end of December, okay? So that's loans within QuickBooks Online. If you have any questions, please let me know. I hope that this was helpful. If it was, please consider giving us a like and subscribe, and I will see you guys next time.